The Rule of 55 is a provision within the U.S. Internal Revenue Service (I.R.A.s) tax code that allows individuals to withdraw funds from their 401k or 403(b) retirement accounts without paying the typical 10% early withdrawal penalty if they leave the job during or after the calendar year in which they turn 55. This can be an important financial tool for those planning early retirement or those who are laid off from their jobs at a relatively young age. In this video, we will break down the details of the Rule of 55, explain how it works, and discuss whether or not it might be the right option for you if you're thinking about accessing your retirement funds early. What is the Rule of 55? The Rule of 55 allows individuals to withdraw money from their 401k or 403(b) plans without incurring the usual 10% penalty if they leave the job during or after the year they turn 55. Typically, if someone were to withdraw from their retirement account before the age of 59.5, they would have to pay a 10% early withdrawal penalty, in addition to regular income taxes. However, the Rule of 55 provides an exception to this rule, allowing penalty-free withdrawals a few years earlier. This rule only applies to retirement accounts such as 401ks and 403(b)s that are tied to an individual's most recent employer. If there are multiple 401ks from previous jobs or an I.R.A. account, the Rule of 55 does not apply to those. Withdrawals from I.R.As, including traditional or Roth I.R.As, are still subject to the early withdrawal penalty unless other exceptions apply. Who is eligible for the Rule of 55? To qualify for the Rule of 55, a few key conditions must be met. Firstly, the individual must be at least 55 years old, or 50 if they work as a public safety employee like a firefighter, police officer, or emergency medical technician, EMT. Secondly, the person must separate from their employer during or after the year they turn 55. It's important to note that the rule doesn't apply to individuals who leave the job before they turn 55 and wait until later to begin withdrawing funds from their 401k. For example, if an individual leaves their job at 53 and wants to take withdrawals once they turn 55, they would still be subject to the 10% early withdrawal penalty. The key point is that the separation from employment must occur in the same calendar year that the individual turns 55 or later. How does the Rule of 55 work? The process of utilizing the Rule of 55 is fairly straightforward. Once someone has left the job during or after the year they turn 55, they can begin making withdrawals from their 401k or 403(b) account without facing the 10% penalty. However, regular income taxes still apply to the amounts withdrawn, just as they would for any withdrawal from a retirement account. The benefit of the Rule of 55 is avoiding the penalty, not the taxes. While this rule allows flexibility for early retirees or those laid off from work, it's important to carefully plan how and when to take distributions. Withdrawing too much too soon can deplete retirement savings, leaving the individual with fewer resources later in life. Many financial advisors recommend taking only what is necessary to cover living expenses, ensuring that retirement funds last as long as possible. Advantages of using the Rule of 55. 1. Penalty-free withdrawals. The most significant advantage of the Rule of 55 is the ability to withdraw retirement funds without incurring the 10% penalty. This can provide financial relief for individuals who need access to their funds after leaving the job early, whether by choice or due to layoffs. 2. Early retirement option. For those who have planned well and saved enough, the Rule of 55 opens up the possibility of early retirement without having to wait until 59.5 to access their funds. This can be especially appealing for those who are ready to transition into retirement earlier than the standard retirement age. 3. Job flexibility. Even if someone returns to part-time or full-time work after they have begun withdrawing funds under the Rule of 55, they can continue to take penalty-free withdrawals from the previous employer's retirement account. This can offer a level of financial flexibility, allowing individuals to supplement their income while still working part-time. Limitations of the Rule of 55. 1. Applies only to the most recent employer's 401k or 403. B. The Rule of 55 is limited to the retirement account of the employer from which the individual recently separated. If there are multiple 401ks or 403(b)(s from previous employers, those funds are not eligible for penalty-free withdrawals under this rule. It's important to consider consolidating old retirement accounts into the most recent employer's plan if possible before leaving the job. 2. Does not apply to I.R.As. The Rule of 55 does not apply to I.R.A. accounts. This means individuals with a significant portion of their retirement savings in an I.R.A. will not be able to access those funds penalty-free before age 59.5 unless they meet other specific exceptions. 3. Potential for depleting retirement savings. While penalty-free withdrawals are beneficial, tapping into retirement savings early can lead to a reduction in the amount available for later retirement years. Without careful planning, individuals could face financial challenges later in life if they withdraw too much or mismanage their funds. Alternatives to the Rule of 55. For those who don't qualify for the Rule of 55, there are other options available to avoid the early withdrawal penalty. 72. T. Rule. This I.R.S. rule allows individuals to take substantially equal periodic payments from their retirement accounts before age 59.5. However, once this option is selected, the payments must continue for at least 5 years or until the individual turns 59.5, whichever is longer. Exceptions for disability or medical expenses. There are exceptions that allow for penalty-free withdrawals for individuals facing total and permanent disability or those with medical expenses exceeding 7.5% of their adjusted gross income. Roth I.R.A. conversions. For those looking to avoid future taxes, converting a portion of a 401k to a Roth I.R.A. can be an option. However, this strategy does not provide immediate penalty-free access to funds and comes with its own set of rules and tax considerations. The Rule of 55 is a powerful financial tool for those planning early retirement or facing job loss. It allows individuals to access their retirement funds without the 10% early withdrawal penalty, provided they meet the eligibility criteria. While it offers significant advantages, it's essential to use this rule wisely and strategically, as withdrawing too much too soon could impact long-term financial security. In this video, we've explored the details of the Rule of 55, including who qualifies, how it works, and the potential benefits and limitations. Understanding the full scope of this I.R.S. provision can help individuals make informed decisions about whether to utilize the Rule of 55 as part of their retirement planning strategy. Thanks for watching. Please subscribe.